we got to start with the Fed rate cut and the dovish tone from Jay Powell. What did you make of that? And also, at this point, as we see the market surge on the back of the election, how important is the Fed compared to the idea of a pro-growth president-elect coming into office, less regulation, the potential for less taxes?
I think the Fed's in a pretty good spot. I mean, it looks like the soft landing is at hand. We have close to 2% inflation, just a little nick to the labor market, and plenty of room for the Fed. And that's the important thing when you put it together with the election, as you were asking. Because, yes, it does look like there may be some inflationary aspects to the policies that could come in. Lower taxes, maybe even a little tariffs. But remember, a neutral rate for the Fed is probably around 3%. So as Powell himself said in his comments, it's still restrictive. So there's still a little bit of defense against perhaps a little inflation from those policies. Also, what is your word of the day? My word is small caps. They had the spotlight, up almost 6% the night of the election. And look, a broken clock can be wrong twice a day, or right twice a day, I should say. And we've been in the camp of liking small caps for a while because of valuation. We'll take the valuation as a defense. They're more sensitive and more responsive to Fed rate cuts, and importantly, potentially resilient if those tariffs have a little bit of a ding on more internationally focused companies. All right, so Simeon, we were talking about this earlier. It seems like you're kind of talking out both sides of your mouth on this one. You say they're more responsive to rate cuts. We got the rate cut yesterday. Still, they closed lower. We also got an indication that we're going to get more rate cuts. As you mentioned, Jay Powell said rates are just too restrictive. They've been underperforming all year, even though we knew we were going to a rate cutting cycle. Your pick for us today is the ProShares Russell 2000 High Income ETF, ITWO is the ticker. Very quickly, give us the why small caps? They don't seem to be performing. They just pulled back, even though they were a Trump trade. Just give us the case very quickly in about 30 seconds. It's going to be episodic. You had a 10% pop in July. You had a 6% the night of the election. They're going to be volatile, but they've been underperforming for 15 years and well-positioned. We suggest our ETF, the ITWO, which is our ProShares Russell 2000 High Income ETF, so that you can get exposure to small caps, but also have some income that the Fed actually just took away. So these are all profitable companies in the ETF? It's the full Russell 2000. You need the full exposure to really take the opportunity to take advantage of the rate cuts. Simeon, I got to say, it seems to be a hard sell. And right now it seems like the market may actually be losing conviction. I talk to a lot of traders. They say it's a trade. It's not a hold. They don't believe that that story has a long-term narrative. When President-elect Trump takes office, we're going to see inflation rise, potentially, if some of his policies get enacted. We've also seen bond yields a bit higher. Doesn't that hurt small caps? If you look at small caps, this is very important. On the large cap side, the steepening of the yield curve does deflect some of the possible benefits of the Fed cut. But when you look at small caps, it is the short end of the curve that actually benefits small caps because they have shorter dated debt and can be more responsive.